When it comes to keeping your hard-earned money safe, the age-old debate of big banks versus small banks always comes up. Both have their pros and cons, but which option truly offers more security and peace of mind for your savings? In this video, we'll dive deep into the key factors that determine the safety of your funds, exploring the strengths and vulnerabilities of large, established banks as well as smaller, community-focused institutions. By the end, you'll have a better understanding of where your money may be better protected. Talking point 1: FDIC insurance and coverage limits. One of the most crucial aspects of bank safety is the protection offered by the Federal Deposit Insurance Corporation, FDIC. This independent agency was created during the Great Depression to restore public confidence in the banking system by insuring deposits in case a bank fails. Both big and small banks that are FDIC insured provide the same coverage limits for each depositor, up to $250,000 per ownership category, per institution. This means that if you have less than $250,000 in a single bank account, your entire balance is protected, regardless of whether it's a large national bank or a small community bank. However, it's important to note that the FDIC coverage applies to each bank separately. If you have accounts at multiple banks and the combined total exceeds $250,000, the excess amount would be uninsured. In this case, spreading your money across different FDIC-insured banks could provide greater protection for your overall savings. So, when it comes to FDIC insurance coverage, there's no inherent advantage for big or small banks. The safety net is essentially the same. The key is to ensure that your deposits don't exceed the insured limit at any single institution. Talking point 2: financial stability and too big to fail. The 2008 financial crisis brought the concept of too big to fail into the public spotlight. This phrase refers to the idea that certain financial institutions are so large and interconnected that their failure would pose a significant risk to the entire economy, making a government bailout necessary. Proponents of big banks argue that the sheer size and systemic importance make them less likely to fail, as the government would step in to prevent a catastrophic collapse. This perception of an implied government safety net could make depositors feel more secure about keeping their money in a too-big-to-fail institution. However, critics counter that this perceived safety net creates a moral hazard, encouraging big banks to take excessive risks, knowing that taxpayers will foot the bill if things go wrong. Additionally, the notion of too big to fail has been challenged by policymakers and regulators, who have implemented measures to make it easier to wind down failing institutions without relying on taxpayer bailouts. On the other hand, small banks are generally considered less systemically important, which could make them more vulnerable to failure in times of economic stress. However, their smaller size and more localized operations may also make them less exposed to complex financial instruments and global market turmoil. Ultimately, the financial stability argument cuts both ways. While big banks may enjoy an implicit government backstop, their interconnectedness and exposure to global risks could also make them more susceptible to contagion effects during crises. Small banks, though less systemic, may face their own challenges in weathering economic storms. Talking point 3: regulation, oversight, and corporate governance. Another key factor to consider is the level of regulation and oversight that banks face, as well as their internal governance practices. In the aftermath of the 2008 crisis, regulators have tightened their grip on big banks, subjecting them to more stringent capital requirements, stress tests, and scrutiny over their risk management practices. Large banks are required to maintain higher levels of capital reserves and undergo regular stress tests to assess their ability to withstand severe economic shocks. They also face enhanced supervision from regulators, with dedicated teams monitoring their activities and potential risks. Critics argue that this heightened regulatory oversight, while well-intentioned, has led to a complex web of rules and compliance burdens that can stifle innovation and competitiveness for big banks. Additionally, the sheer size and complexity of large financial institutions can make effective oversight challenging for regulators. On the flip side, small banks are generally subject to less stringent regulation and oversight, which can provide them with greater flexibility and agility. However, This reduced scrutiny could also mean that potential risks or unsound practices may go unnoticed until it's too late. When it comes to corporate governance, big banks often have more robust internal controls, risk management frameworks, and independent boards of directors to oversee their operations. These measures are designed to promote accountability, ethical behavior, and sound decision-making. Small banks, on the other hand, may have less formalized governance structures, relying more heavily on the integrity and judgment of their leadership teams. While this can foster a closer connection with the local community, it also introduces potential conflicts of interest and concentration of power. Talking point 4. Customer service and accessibility. Lastly, it's essential to consider the customer experience and accessibility factors when choosing between big and small banks. Large national banks typically offer a broader range of products and services, as well as a more extensive network of branches and ATMs across the country or even globally. However, this convenience often comes at the cost of personalized service. With millions of customers, big banks may struggle to provide the same level of individualized attention and tailored solutions that smaller institutions can offer. In contrast, community banks and credit unions pride themselves on their ability to build closer relationships with their customers, offering a more personalized banking experience. They may have a deeper understanding of the local market, allowing them to craft solutions that better meet the specific needs of their clientele. Additionally, small banks often have a more accessible decision-making process, with loan approvals and account resolutions happening more quickly and efficiently than at larger institutions with more bureaucratic layers. Ultimately, the choice between big and small banks comes down to weighing these various factors: safety, stability, regulation, governance, and customer experience, and prioritizing the aspects that matter most to you and your financial situation. Conclusion. In conclusion, there is no one-size-fits-all answer to whether your money is safer in big or small banks. Both options have their strengths and weaknesses when it comes to factors like FDIC insurance coverage, financial stability, regulatory oversight, corporate governance, and customer service. The key is to carefully evaluate your specific needs and priorities, and choose the banking option that aligns best with your risk tolerance, financial goals, and desired level of personalized service. By understanding the nuances of each choice, you can make an informed decision and find the right fit to keep your hard-earned savings secure.